Now that we got the details and the explanation out of the way, we're gonna start getting into the real stuff that this indicator has, and we're gonna go through the explanation of the elements one by one, and hopefully by the end of this online course you get familiarized and get used to every single thing that you can see here in the chart. Now remember guys that this online course is not meant for me to teach you a strategy, but for me to teach you the concepts that is drawn from the name of the price action concepts, or the concepts that are used in this indicator, regardless of the type of the strategy, of the type of the trading that is going to be involved here. And as I said before, this indicator is not dedicated only for the smart money concept or the inner circle trading, but it's in general for the price action trading. And I'm gonna start first with the structure, or the market structure, and to do so I have to remove every single element here and keep only the element that I want to be talking about, and I'll try to go through that element individually and talk to you a lot about it in general. So I'll start here with removing the equal lows, the previous the premium and the discount zones, the fair value gap, these here, this one here. So let's just try and remove anything that is relevant to what we are doing here. So I'm removing the session as well. I'm keeping that, removing the other block, removing the boss, and these as well in general. So what I have here, I have the market structure, and so what I'm going to do is I'm going to increase these to 2000, and I'm going to try and show as much as possible of the smart price action here. And there you go. Now I have enough bars to read what's going on in the chart in terms of the structure. Now the idea of this indicator is to help you visually determine the bias and determine the structure of the market. And as an example here, I have this lower high, this one is lower than this one, and the market kind of goes in this way: lower low, lower low, lower low, and a series of lower highs. A standard definition of the downtrend is a series of lower lows and a series of lower highs, and that's exactly what I have here. Now I have visually a visual indication of what is going on in the chart, and regardless of anything that is happening in the chart, you have this indication that you can use in your favor. And usually the market structure is used to determine trends and to ride trends. And I'm going to give this example here of this lower low with this lower high. That confluence between the two is what creates what we call support and resistance. Now I have the price coming back here and revisited this lower low and then got rejected off of that level. This is exactly why I am saying all the time that this tool is a versatile tool and can be used in any kind of trading style that involves price action, regardless of the type of trading that you are doing. You are going to find an element or two that you can integrate in your trading. As an example for this, what I can see is that the price have been going in a downtrend, clearly forming this lower lows and lower highs, and that gives me a better confirmation that here what I have is support that supported the price to the upside. The price came back, broke below that support, and found little resistance here, which pushed the price even lower. And this gives me more. Actually, this point here and this point that supported the price came back strong, broke below that, and then found the resistance, pushed the price lower. Now I am expecting this level to be an important level, because I have this point to be the first point, this one is the second, this one is the third, and now I am expecting something really intense to happen at this level. And that's exactly what happened. The price came back to that previous support and became resistance, and I got this lower high, and it showed me that there is a possibility that the price might go lower. Now what I'm gonna do there is, whenever I see a sense of direction to the downside, I am going to get that as an entry, and that is going to be my pullback to ride the trend to the downside. And as you can see, guys, the price have been moving lower and lower and lower since that point. At this moment here, where I have a momentum shift, I am getting a different reading than the reading of the downside, the downtrend, in which happened at this level right here. And this is what we call a change of character. Now, the moment I got a different reading, which is a higher high here, that is a sign of a change, which means that the price on a swing higher time frame was moving lower. And then now when I got this higher high, I am shifting my perspective to probably a sideways move or a shift to the upside. When I got this higher high, I got another higher high, and the price moved back, and I have another change of character. Now, when you see this change of characters happening again and again, that means that the price have not been decided yet to which direction is going to take, and that's what creates a range. The price is indecisive, and there is indecision in the price, and that makes the price creating this higher highs and then creating a lower lows and then creating another high here and then another high and then another low. And this is probably an expanding range, and you can see, guys, how it is narrow here and becomes much larger on the end. And this is in general how the swing moves is going to be useful in this sense. It's going to help you read the trend in general, and also it's going to help you with the reading of the swings themselves. Now, if I have a swing detected, I am going to read what is going on in the price, and with that, I am going to use that in my favor to decide on what is going to happen next. That is on one hand. On the other hand, I am using the Fibonacci here, and I have two useful ways to use the Fibonacci. I am using the Fibonacci on the last swing, which is this one here, for example, and I can use it on this swing right here. If I click again on that, the measurement is going to move towards this swing right here. Now, with that being said, I am having a measurement of all the last two swings, which are going to be important in my analysis. And as an example of the use of the Fibonacci with this swing or the market structure, I have a lower low here, I have a lower high here, and I have a higher low that is higher than this lower low, and I have a higher high. What this tells me is that the momentum is shifting to the upside, and I can use then the Fibonacci level to measure this last swing and to find an entry. That's where the premium and discount zone are going to come in handy. And I'm going to take advantage of this moment to explain the premium and the discount. Now, when I'm in uptrend, and this is general explanation, guys, this is price action explanation. This is not smart money concept. If you want to learn about smart money concept individually, in ICT individually, I have these things in details in the academy. But for now, we're talking in general. We are talking general price action. Now, I have a shift of the momentum to the upside, and I can draw my Fibonacci on the last swing, and I have my premium and discount zone. Now, the premium and discount is what shows you exactly how can you take advantage of the Fibonacci levels in other way. Now, what you want to do is when you are in an uptrend or when the momentum is to the upside, you don't want to buy at this area right here. This area is going to be a premium area, all right? From the equilibrium to premium, that is a premium area. And if you want to buy, you should buy at a discount. When you want to sell, you should sell at a premium. In other words, if you have, for example, an iPad or something like that, and you want to buy an iPad, you have to buy it at a discount and in a way that you're going to save more money, if that makes sense. But if you want to sell that same iPad, you have to sell it at a higher price so that you can get the difference. So let me explain that even more. So you have an iPad, you bought an iPad that you are planning to sell. So you have to buy it at a lower price, which is a discount at some level here. You have to buy it at a discount so that when you want to sell, you have to sell it at a higher price, at a premium price. In the same way, in an uptrend, we are looking for a buy because we are riding the momentum to the upside. And when we are looking for a buy, we have to buy cheaper and we have to buy at a discount. So any price at this equilibrium is fair value. This level here is fair value. What's the meaning of a fair value? The meaning of a fair value is if you divide the higher price and the lower price, or if you do the sum of the higher price and the lower price and divide it by 2, that's going to give you this equilibrium. That's an equal different distance between the higher price and the lower price. In other words, the fair value is going to be for an iPad that costs, for example, here in the market, the price here would be like $300 and here $400. So from 300 to 400, 350 is a fair price that you can pay for that iPad. So the price comes back to that fair value, which is the equilibrium. Now you are comfortable to pay that 350 to buy from there. Anything lower than that, now we are looking at a better price. So you can pay, for example, 300 at this level of 618 of the Fibonacci. Now probably you're going to pay 300. Now if you pay 300 and you go out in the market of iPads and you sell it, you are not going to sell it at this area here, because if you sell at this area, then you are losing money. You paid more than what you are getting for it. So, but the market, the way the analysis have been done is in the way that the research that you have done is going to be that in a way that when you go out there in the market, you're going to find that the prices are 315 above. Now you paid 300, so even if you sell at a equilibrium at a fair value of the market, you're going to get that $50 profit because you paid 300 and now the price is 350. This is exactly the meaning of premium, equilibrium, and discount. And if you keep this analogy in your mind with the iPad, you are going to be at a better place in terms of the understanding of this. So what you want to do is you want to always buy at a lower price than the equilibrium. When the price retraces back to 50%, that is a good place to buy. As far as this place comes, what you need also to do is you need to be a lot more careful, because when the price, goes lower and lower, that is somewhat a sign that there is something going on. That might be, the market of iPads might be, plumbing, and then when it goes lower and lower and lower, now the value of that iPad is changing. So at this area here for me, from this level right here, and this is personal perspective from my personal experience, at this level right here, the value of that iPad is going to be somewhat, even if you have this level here, and you might think that I might have an order block here, and something lower than this is going to be very risky. So, and that's where order block comes. And as you can see, guys, I have an order block, and this is again a chance to talk about order blocks. So if the price comes back to this order block, this is going to be for me a perfect entry. But on this level here of this order block, this is going to be a very risky move. The price might want to retest this level and go up, but as far as I'm concerned, I am interested in this order block a lot more than this one here. So I'm looking at this order block, and I'm looking for the price to come back to that order block here, and then probably to the upside, and that will be a very perfect place to take a buy. Why? Because that is a discounted buy. That is as discounted as it can be. Now, this is maximum discount, and remember, nothing is perfect. You will not get that perfect setup where the price is going to be lower, and that where typically you want to buy here. But that's very risky. Then if the price goes to this level, as I said, the iPad is losing value, and the value of iPad is losing. That might push the price even lower to unknown values of the iPad. You probably bought it at 300, as we said, and now you are going to sell fill it at at 100, or who knows, if the price even go lower, you might lose the whole value of that thing, and you might get stuck with that iPad. Nobody wants to buy it from you. Might come back to an equilibrium, what we call fair value, moves lower even to a discount level, and the discount level, the perfect or the typical discount level is going to be somewhat this level here at the order block. Now remember, the order blocks needs a fair value gap, and when a fair value gap is detected, that means in general that the price has to come back to that level and fill it up. Now we are waiting for the price to come back and fill this fair value gap up, and then that will be in confluence with this order block. And also, this is something that I want to put out there. The order block without the fair value gap does not mean anything. Now we have these two conditions. We have the fair value gap, which means that, and I've explained this in the previous video, a fair value gap happens when the price moves faster without even looking back, without close. Now this wick can be considered as somewhat price coming back to fill this up, this level up, but we did not get any close, which means that this is a gap that needs to be filled later on, which means that the price has to come back to fill that level up. And then now with the fair value gap is also a condition for this order block to be here, which makes more sense for the price to come closer to this low right here. And that's the most important thing that the order block tells you, is that it shows you a level where the previous low can be a support to the price to the upside after the fair value gap is filled. Now the price comes back, fills the fair value gap, and then found this low, and this low is a zone rather than a level. Now you don't have to wait for the price to come back to this wick right here and fill that up, but what you can do is you can just start looking at a buy at an equilibrium again. An equilibrium, just keep in mind, an equilibrium is the difference between the high and low. And this is the low of this bar, this is the high of this bar, and this is the equilibrium level. If the price comes back to that equilibrium, that's another fair value. And lower than that, a little bit lower than that, that's another discount. A perfect level to buy would be at this low right here, but again, if the price comes back to that low, you want to be protected and you want to have your stop loss typically lower than that low, probably below here, below this higher low right there. So if you have your stop loss there, the price comes back right at this equilibrium of the order block, that is going to be a typical entry. Filled up the fair value gap. We have a bunch of fair value gaps here that needs to be filled up, which makes more sense for us to bet on the price to go up to fill those fair value gaps again, all the way up to this level right here, to the premium. And then remember, we want to sell at premium. Whenever you get at premium, let me just bring this one here over, or just to remove the time frame. So when the price moves in this manner right there, and to this equilibrium, that's going to be your entry. Now your target is going to be typically something like here, without even waiting for the price to again reach this equilibrium of this order block. And that's another order block right there. Let me just remove that rectangle. Now I have another order block here. The fair value of that order block, or the equilibrium of that order block, is at that level. I have a fair value gap here that has been filled, right, if the price moves in my favor. Now my typical take profit has to be right there at this low, just to remove any chance of the price touching that level and moving back lower, because that happens a lot. And you saw it in that levels I showed you here, where the price was not going anywhere, was just moving sideways. That's exactly what is happening here. The price might come up until this level here and touches the order block and moves lower again, and in the same way again and again and again. So you want to take that in consideration and take advantage of this low right here to take profit, and then you are out of that trade. And this is typically a typical way to trade this setup here. This is again a general price action. It does not really have to buy smart money concept or ICT. I'm gonna go in details, as I said, in the academy. So if you are interested into learning each and every one and then combine, there is going to be tons and tons, hours and hours of videos in the academy teaching you exactly every single thing about this stuff. All right, guys, with that being said, we are going to wrap this video up and talk about other elements of this indicator and details in the next videos.